thank you for inviting me here today. Thank you for your time. Southern Protective Group, I can tell you a little bit about us and a little bit more than was just said. We're a medical malpractice liability expert. And this is all that we do. We're an insurance brokerage firm. And a lot of firms focus on property and casualty and workers' comp and general liability. What we do is MedMal for physicians. We work with physicians, solo practitioners, small groups, healthcare systems, associations. We work with those all around the country. They all have unique needs. There's different specialties. We work with all of them. So we exclusively focus on medical malpractice. And we're headquartered in Woodstock, Georgia. I personally live in Atlanta, Georgia. And we have clients in about 35 states, but we're licensed in all states. So our agenda here today is to talk about the current state of the medical malpractice marketplace. As was just mentioned, there was a time where physicians were moving states because of MedMal and the cost. And so we'll get into sort of a little bit of a history of where we were and where we're headed. We'll talk about coverage options and policy considerations. We're going to go into the weeds a little bit on what an insurance contract looks like in medical malpractice marketplace so that you understand how to navigate your options. And then finally, we'll talk a little bit about risk management and just some basic risk management strategies that you can implement into your practice to mitigate your overall risk and lower your chances of being sued, which ultimately improves your opportunity to buy affordable coverage. So that's where we are. So we'll start with the current state of the medical malpractice marketplace. So as was mentioned before, we started with, in 2001, there was a medical malpractice crisis. There was a few carriers that were in the market that were large multinational insurers. And there were some folks in a boardroom that were looking at their loss ratios of professional liability in the physician space, and they decided, hey, we're not making any money, so let's dump it. And so at that time, they non-renewed insurers all around the country, and there was a crisis. And so what occurred was every state came up with their own solutions. And in Georgia, where I'm from, there was Medical Association of Georgia came up with Mag Mutual. In Alabama, there was a solution that became ProAssurance. In Florida, the Doctors Company, State Vol in Tennessee, Macam in Mississippi, Lamico in Louisiana. So they all came up with association-driven or state-funded programs. And if they were state-funded, that's one thing, but most of them were mutual solutions. And in the meantime, there was a lot of tort reform. I mean, they say, how do we reduce claims? How do we, our doctors are getting sued, they're losing big judgments, they can't afford coverage. And so there was a lot of tort reform. And so since 2001, fast forward to about 2007, we had some players in the industry that were able to provide coverage, mostly a single dominant player in a state, like a Mag Mutual or ProAssurance or the ones that I mentioned. And at the same time, what we saw was frequency of claims was headed down. I mean, technology in medicine has really really started to emerge. And where there were certain specialties like anesthesia that used to be one of the highest risk categories, it's trended downwards year over year since that time. So it's actually, from a pricing standpoint, it's not close to one of the highest at this point in time. So we saw frequency going down. We saw these carriers that were, started in individual states say, hey, we need to go out into other states. We need to gain market share. And they all began to, expand and improve their contracts and improve their contract language and the terms. And what we began to see was what's known as a soft market. And that's a market where for physicians, it was more of a buyer's market. And so over the last, probably from 2013 to 2017, what we saw was, a lot of MedMal insurers were one-upping each other with better terms, better pricing. They were buying business, they were buying market share, and really trying to gain traction in new markets. And so that's what we refer to as a soft market, year over year premiums going down, down, down. And at the same time, frequency was going down, and eventually that just, you can't continue to undercut your own pricing. I mean, personally, in my experience, we worked with a very large group that was spending about $600,000 on an annual basis. They asked for a competitive option. We brought in a solution that was about $380,000. So clearly they were paying a significant rate with their incumbent carrier. Well, their incumbent carrier they'd been with for 30 years matched our pricing at midterm. So a carrier that was spending $600,000 was able to cut out 200 or collecting $600,000 was able to take out $220,000 right out of their premium just to keep the business. And so eventually that kind of catches up to you. So what we've seen now is sort of a bottoming out of that soft market. At the same time, we've seen severity increase. And what I mean by that is the claims that we are seeing, oftentimes physicians buy $1.3 million or $1 million of coverage with $3 million in aggregate. And we've seen policy limit claims all over the country, and some that we'll get into some statistics that are significantly larger than policy limit claims. So we'll get into what the future holds, but first I'd like to get through some claim data just to share with you of what's going on here. So in this particular graph, the blue line represents the premiums in the industry and how much is out there that insurers are collecting. The orange line is actual medical professional specialist carriers, ones that exclusively focus on MPL alone. You can see that in '96 there was MPL specialists, and then there was a good deal of market share with folks that were the CNAs, AIGs, Chubbs, the large insurers that work on all types of risks. And what we've seen is over time, the specialists have gained more market share. And as you can see right here in 2001 is when we started to have this crisis and rates began to go up. And obviously the healthcare industry as a whole has grown. We can see a trending downwards of premiums that have been collected in the industry. And you can see this represents the percentage of market share by the MPL specialist in the marketplace. So the takeaways here are the direct written premium is down and the specialty carrier market share is increasing. This slide, the net underwriting results and combined ratio. First, when we talk about combined ratio in the insurance industry, it's a formula of how essentially for every dollar they're taking in, an underwriter's taking in, how much are they paying out of the back end? And so if it's $1, that's a 1.0 loss or combined ratio. And what we're seeing in industry is in certain states, certain counties, certain specialties, we're seeing combined ratios that are in the 1.4 or 140%. And that means that the insurers are taking in $1 and they're paying out $1.40 on the back end. And it's really not a sustainable model. So this graph here, with the data shows here that there's in 1996-2005, there was $16.1 billion in underwriting loss. And then from 2005 to 2017, you can see a flip in that trend. And this orange line represents the combined ratio. So during this time of underwriting loss, the insurers, for every $1 that they were taking in, they were paying out at a peak of almost $1.60. Can't really make money like that. So that corresponds with this 2001 year where we began to have that crisis. This is when for obvious reasons, an executive's in a boardroom is saying, hey, we can't make any money here. Let's get out of this industry. And during this time frame is when we saw the state-specific specialty carriers come in and the tort reform that we've seen to drive down pricing. And then what we've seen was sort of bottomed out, and frequency and severity, with frequency is leveled off and severity has come back. And in some states, we've seen tort reform repealed. So the takeaway is the trend is going back. So from a hard market to a soft market, And we don't know exactly what the future holds, but we have some ability to predict it. Frequency is just a pure volume of number of claims, obviously, so how often are they occurring? Severity is how big is the judgment, and frequency of severity is how big are the big judgments. And so what we're seeing here is obviously 2014, there was 18 verdicts over $10 million. In 2018, we saw 44. It's a big trend. Those are big numbers. So with 25 million, we saw 4 in 2014 and 17 in 2018. Now, some of these, like in my Cobb County, Georgia, a jury awarded over $60 million. And now in that case, the defense didn't show up. They literally did not show up, and the jury wanted to send a message. And you can look it up, but it involved a death claim, doc in the box sort of situation. So some of these are a little bit of an outlier. No one's paying $60 million in a claim. But this is sort of what we're trending. I think the American culture in general is trending towards, hey, there's a big bad insurer. Let's, regardless of fault, let's figure out a way to, make a patient whole. And if there is fault, let's make them pay. And that's what we're seeing here. So over the last 24 months, we've seen some failures in the industry. There's insurers that are, stock traded. There's insurers that are mutual, and then there's insurers that are, just starting out. And so we've seen 8 failures or carriers that are operating in insolvency, PRIs, in the state of Florida, the state of New York, and New York just won't let them go into insolvency because of a crisis that it would create. So they're actually still operating, but many of these aren't. Same with academic, they're still operating in insolvency. So we're seeing a trend where some of the smaller players that we're trying to gain market share are no longer around. I'm often asked, how often claims are paid on lawsuits, and for the most part, when there is a suit, most of them are defended. I mean, and defended well, and they're settled out of court if they're not. So very seldom do we see a case go to a jury trial. Most of the time, especially in this market, you have a MedMal specific carrier. They are rigorously defending their doctors. And if there was a bad outcome due to, some negligence or some, sometimes things are obvious. Sometimes there was something bad happened and there needs to be a payment there to make someone whole. And generally those are settled. So when you're looking at carrier options, what do you look for? We have in our industry AM Best, which is an independent third party that ranks insurers by their financial stability and solvency. And we don't sell any carrier that's under AM Best A-. So if they're at a B++ or below, we have a mountain of paperwork that we require our clients to sign. Basically signing off on the carrier's not so stable. So you want to look at financial stability. You want to look to see if it's a physician-focused insurer. If you're going to work with CNA, they're a fantastic organization, but they're around the world. They're in trucking, they're in healthcare, they're in construction, they do everything. Or are you with a medical malpractice specialty insurer? Are they a mutual company or are they a stock company? That's important just philosophically to some of our clients. If it's a mutual organization, when you buy a policy, you're technically an owner of that company in some regard, and you have voting rights on who's on that board. A stock company, they're trying to return the shareholders' value. And so when it comes just philosophically to how they do business, they need a profit for Wall Street, where a mutual company returns the profits to the policyholders. Is it a standard company or is it a non-standard company? A standard company in our lingo is one that's approved by the state that you're in. And so in Alabama, If an insurer standard, they would have a contract. They go down to the state insurance office. That state insurance office reviews the contract, reviews the rates, and puts a stamp of approval and says, hey, if this organization is insolvent, we'll pick up their claims. So it's basically a insurance for your insurance. If they're non-standard, they don't do that. They don't go into the state. And there's advantages and disadvantages to both. So non-standard could be the right fit for you. It just depends on where you're practicing, what your specialty is, and why you potentially may need a non-standard carrier. But for the most part, on a whole, people go into the non-standard marketplace when they've had claims, or they've had board actions or some sort of issue where they can't get a traditional standard market to provide them with coverage. How much business does, if you're going to work with an insurer, have they defended doctors in your state? They defended doctors in your county. Where are they located? That's important. If you've got a multi-state operation, can they handle? If you want to go from Alabama to Tennessee and grow into North Carolina, can your insurer do those things with you? So it's important to understand their footprint if you're looking to grow your footprint. So what kind of terms do they have? And that's going to be our next segment, is really diving into the insurance terms. And there's some insurance policies just in general, like buying a car. All of them say car, but you can get a Pinto or you can get a Porsche. And a lot of these policies are about an inch thick. And I've never met a client that's read one. I mean, raise your hand if you've read any one of your insurance policies from front to back, or would even know how to look through it in a way to find key terms. And the answer is, I purchase insurance outside of myself, and I don't read the policies. So it's important to understand some terms and to work with someone that can explain those terms to you. Next slide here talks about the top 10 MedMal insurers as ranked by the NAIC 2017. Berkshire Hathaway is a company known as Medical Protective. They've been around the longest and have the largest market share, and they're a stock traded company. The Doctors Company is a mutual company. CNA is obviously, they're a stock company. Pro Assurance Mutual, Caveris, they're up here in New England mostly, and they're growing into a national footprint. Milmic is New York based only. So you can see Milmic, only being in the state of New York, is the 6th largest insurer in the country. That just gives you an idea of the type of premiums that doctors are paying in the boroughs. It's a very litigious state. NorCal Mutual is a national carrier, and they're here today, and they're 7th on this list. Mag Mutual, the one I mentioned, that's headquartered out of Georgia, they're the largest insurer in the South, and they're in most states as well. Most of these that are not in all states are trying to get in all states. And going back here, if I were to list 11 through 15, in that list it would be Chubb, AIG, and several other really well-known carriers that are in this space, sort of on the bottom end, but they're trending to getting out. So next steps are, nearly everyone I talk to that's an independent physician, they have coverage. If you don't have coverage, outside of South Florida, there's really not a place where I see folks that go bare. There's only a handful of states that legally require medical malpractice insurance. Believe it or not, it's not compensatory, it's not statutory, but in about 6 states. But in most states like Georgia, Alabama, and most states in the South, it's actually just a part of the, if you want to work in the hospital, you want to work in the industry, you have to provide a certificate of insurance for your MedMal. So it's not something you can avoid. And so the majority of folks have it. South Florida, believe it or not, it has a culture of not buying medical malpractice insurance. And legally, they have to put a sign in their window that says, hey, we don't have coverage. So get treated at your own risk. But for the rest of the market, people are buying coverage. And there's some nuances with claims made and occurrence policies that have people say, hey, wait, I bought a policy already. Kind of like disability, when you buy a disability policy, it's something you buy for life. Well, medical malpractice insurance is not a policy you buy for life. It's an annually renewable policy. And terms are subject to change, and pricing is subject to change. And people say, hey, well, I can't switch. I've got an open claim. Or I need to purchase tail insurance, or what happens? And so to answer the first question about who handles my claims, if you have an open claim and you're with an insurer and you transition to a new one, your old insurer will continue to defend you. I mean, they continue to work with you. Most of the ones on the top 10 list, if they were to do anything outside of defending you to their best ability, it would ruin them reputationally and they wouldn't be in the industry anymore. So do I need to purchase tail insurance? How does that transition work? That's something that we need to dive in a little deeper, and that's going to be over the next few slides. So how many in the room have heard of the term tail coverage or tail insurance? How many would think they have a basic understanding of what it means? Okay. Well, I'd love to hear someone's thoughts on that, because I would say 99% of the time when I ask that question, oh, I know what that is. That's that coverage you have to buy when you retire, or whatever it is. It's typically incorrect, just because there's a lot of misinformation in the marketplace. And if you were to Google, what's the difference between claims made and occurrence, you'll find that it's in the information on the internet, and what you'll find in business school and the business classes and med school is they all recommend occurrence coverage. And we'll talk about why that's incorrect for the physician space, and what exactly is tail insurance and when do you need it, and would you ever have to buy it? So claims-made policy is a policy providing coverage that is triggered when a claim is made against the insured during the policy period, regardless of when the wrongful act that gave rise to the claim took place. So these are the two types of policies. And just to back up, occurrence policies are the type of policies you buy when you buy auto insurance. I mean, you buy, it's an annual period. If you've had an auto accident, you turn in the claim. If you don't have an accident, you don't have an accident, and you buy a new policy. So you buy another occurrence policy. Well, claims-made policies, when a claim, regardless of when the wrongful act occurs, so if you saw a patient 2 years ago and you're in a claims-made policy, you turn in the claim to your current carrier. If you have an occurrence policy and you have a claim from 2 years ago, you go back to that policy from 2 years ago and you turn it in to that carrier. It may be the carrier you're still currently buying insurance from, but nonetheless, it would go underneath that policy that you purchased 2 years ago. So an occurrence policy is a policy covering claims that arise out of damage or injury that took place during the policy period, regardless of when the claims are made. So let's talk about some of the differences. So in claims-made policies, there's lower premiums in the earlier years, which the next slide we'll dive into a few more of those details. It requires a retroactive date. And you may need tail insurance. Occurrence policies, you don't need tail insurance. And premiums are generally slightly higher. And coverage for period never ends. And so I've got a little slide here that gives you an example. If you have an occurrence form, here's where you saw the patient. The claim was filed after the policy expired. Well, you're covered. You just turn it into this policy. Well, if you had a claims-made policy for that same year, and then in this example, you don't renew your coverage or purchase tail insurance, and a claim is filed after the policy ends, there's no coverage. That's the key difference. The reality is, right here, you're always buying coverage again. And the reason why the claims-made policies are better for physicians is oftentimes there's a long tail of when you'll receive a lawsuit. Nearly every state, or most states, have a 2-year statute of limitations. And that's from when a patient knows about an injury. So you saw a patient, you sewed them up, you left a sponge inside. I mean, this happens more often than you think. They don't discover that for another 9 months or a year. As soon as they discover, they have 2 years from that date to file a claim. Well, what happens if you bought an Occurrence Form with Oceanus, who was on the previous slide as insolvent. And you purchased Occurrence, then you transition maybe right here. In the current year that you're in, you purchased the doctor's company, NorCal, MagMutual. You went to another insurer, and you're on Occurrence. Well, when that claim's filed, you go back to when you saw the patient and filed under that policy. And if that carrier is no longer solvent, the answer is you don't have coverage. It's gone. And you got to keep up with this information. And even if they're, still in business, are they still in the MedMal space? If it's CNA and they've dumped MedMal, they're out of the business completely, do they even have the resources to defend you properly? So the claims made policy, your beginning date of your insurance policy is what's called a retroactive date. And at the end of a year, you renew your coverage, whether you stay with your current insurer or move to another insurer. Everything from your past carries forward to the new policy. So when you do have a claim and you have this incident, had you purchased coverage, again, you would be providing that claim to your current insurance provider. To me, that's a major advantage because you're working with a partner that you're providing a claim to your current partner. Well, let's see how the price shakes out. So in an occurrence policy, because it stays on the books forever, you're essentially buying a one-year tail every single time you buy the policy because you're buying a one-year policy that stays in place forever. So in that instance, premium's about 112%. For a claims made policy, your first year when you first buy it, at the end of the year, it's going to be gone. So this policy is going to be, unless you purchase tail coverage or renew, this exposure is gone. And so on day one of year one, you can't be sued for anything in the past. And so they give you a really big discount in your first year. So in a vacuum, this isn't always, depending on the state and the county, this isn't always this cut and dried, but you're saving money on the front end. And you can see that in year two, you're still paying the same amount, given if you're the same physician, you do the same specialty, you're in the same county. Year two with the claims made steps up, you're paying a little bit more. And then year five is when a claims made policy is when the actuaries in most states, they say, hey, we're not going to see we're not going to see claims from 6 years ago. Actuarially, we're not going to price for that. Yeah, we could get them. There's an outlier here and there. But from there on, you'd be carrying forward, when you buy this policy, all your past exposures from these years, and you're paying a level rate from there on. So in this hypothetical example is a physician that, in a mature claims made policy is paying $15,000. So let's say they're, a physician that's a plastic surgeon, and they're with a surgical group, and they decide to go out on their own and become a solo practitioner. Well, their first year they'll be paying $2,100. Well, if they buy an occurrence policy, it's $16,800. So there's quite a bit of difference there. And as these years progress, there's a total savings of $34,000. That's pretty good. But what about the tail insurance? That's what we're going to get into in just a second. So the cost of tail, which is a short way of saying extended reporting period coverage, is generally 2 times your annual premium for an indefinite period of time. So in these contracts, when you're buying medical malpractice insurance, in the contract, they automatically have the ability for you to buy tail insurance. Let's say you were to quit. You just said, hey, I'm done with plastic surgery. I'm going to go, open up a coffee shop. I'm done. Or whatever, for whatever reason, you're out. Whatever year you're in, the majority of insurers have it contractually obligated that they will provide you a tail if you pay them 2 times your annual premium, and that's due inside of 30 days. And that tail coverage will cover you for life. It's an indefinite period of time. So you have a policy at that point that covers you forever. So in this example, if you hang it up, you'll be paying $30,000, which really kind of takes out that savings in the long run. But what we see is, do people even ever purchase tail? And the majority of physicians that we work with never actually have to purchase it, because most of the marketplace provides it to you for free if you in these three events: death, disability, or retirement. And so if you retire, majority of the marketplace is just giving you tail for free. So you've saved this money over the time frame, and you never had to purchase the tail. Well, if you move from plastic surgery ABC to DEF and you want to go work for someone else, you can generally take your prior acts with you. If they have a policy, they can pick up your prior acts, and you can transition your past exposures to a new policy and never have to actually purchase a tail insurance. And that's what happens, here. If you're in year 3 and you want to change insurers and work with a new group, they pick up your prior acts. So you don't, when you transition, you're not buying tail. You're basically, an underwriter is saying, hey, we're willing to take on what you've had in the past. We've underwritten you, and we're ready to move forward. The final thing I'll note is, this is really important to know. And again, 9 times out of 10, when I talk to a physician that's just out of residency or buying coverage for the very first time, they're like, I want an occurrence policy. Well, to be quite honest, there's really only 2 players in the market. And so if you do want an occurrence policy, you can get it. But what happens if they want to change their rates or change their pricing structure or get out of the business altogether, your specialty? There's only a couple options in the market where the majority of the marketplace is claims made. And for insurers, it's easier for them to predict their claims when they don't have occurrence policies sitting in the past that could sneak up and bite them in the future. Every year they're underwriting their book of business, and they understand the type of claims that they might receive. So policy provisions and considerations. Let's see how I'm doing on time. Consent to settle. Who has the consent? So when you buy a policy and you're sued, this is important. I mean, we already showed you that majority of lawsuits never actually make it to a claim status, or defended successfully or dropped. And so what if you are falsely accused? An insurer says, hey, we want to settle. Who has that right? So you want to know, do I have the right to consent to settle, or does the insurer? Well, if it's you, they could slip in something in there called the hammer clause, which means, hey, we can settle this for $100,000. We feel like we can get out of it. You want to defend it? Fine. We're going to pay $100,000, and our defense cost ceases from here on out. And there's different versions of the hammer clause, but that's basically saying, hey, go for it. We have $100,000 if you lose. Are your defense costs inside or outside the limits? If you're buying $1 million of coverage and you spend $250,000 to defend your claim, does that erode your $1 million, or is that separate? And the majority of the marketplace for the medical professionals, specialty carriers, it's outside. So hypothetically, defense cost is unlimited. I mean, you can defend it till the cows come home, and it won't erode your limit. Claims made occurrence, we've covered that. What kind of value-added enhancements do they have in the policies? Is there administrative defense coverage? If you have a board action, what happens? If there's a breach, cyber liability is a major issue in the industry. Right here in the state of Alabama, we had a major system that was under cyber attack recently that was held for ransom, and they were out for 2 weeks, and they paid the ransom. So what happens? Does your policy have a little bit of coverage in there? Or for solo practitioners, it may not be as big of an exposure as a major health system, but if you're capturing patient records, do you have a cyber policy? And oftentimes the answer is no. Does your MedMal coverage provide you with anything? This is an important one right here. Claims trigger is incident sensitive or written demand. if it's incident sensitive, as soon as you know about a bad outcome, you provide it to your insurer. It's theirs forever. It's their claim. If it's a written demand, legally they're not obligated to do anything until there's papers, till the lawsuit process is started. And this can be cumbersome, right? Because if you have an insurer that you want to get away from, sometimes physicians do have claims, and they're with what we see in our marketplace is a physician that has claims or a board action or something that makes them a little stickier of a risk. We have to take them from the standard to the non-standard marketplace. And when they go into the non-standard marketplace, they may have a contract that's a written demand, which means the insurer that they're currently with doesn't legally accept the claim until they've been sued. But what happens if someone dies on their watch in that time frame? They may report it, and years go by, and they're waiting to be sued, and they're a year and a half in, and they get an offer from a new insurer that says, "Hey, we're willing to take your risk. We can transition you to a better contract, but we need to know, have you reported all your current claims?" Well, yeah, I reported it. I reported it to my carrier, Oceanus. What kind of contract does Oceanus have? Well, they have a written demand contract. So at that point, your new insurer that's provided you a quote is saying, "Oh, so you have a claim, a death claim that's hanging out there that your current insurer is not legally obligated to take yet until you're sued." And essentially, if they provided you with coverage, picking up your prior acts, they'd be buying that claim. And it just doesn't happen. So if you're in this written demand, we've seen some issues where groups are trying to transition away from providers and just can't because there's potential lawsuits hanging out there. Or maybe not even the potential of a lawsuit. But if you're an underwriter in a standard marketplace, you say, "Hey, they have a bad contract. They told us they don't have any claims, but how can we be certain?" But if you have an incident sensitive, you report your incident to NorCal, MagMutual, whoever it is, and at the day that you report it, it's their legal obligation to defend you in that claim. Limits? How much should I buy? I get this question a lot. For me, when I talk to my clients about their limits of liability, insurance is a promise to pay when things go wrong, and you have to have a comfort level with what you're buying, and every insurance policy has a cost. And so if you have $1.3 million and you're not comfortable with it, and $2.4 million is 10% more, maybe that provides you a little more comfort. But there is an industry standard in every county and every state. At Florida, $250,000 is the minimum, and is actually kind of the average. Most people buy $250,000 per occurrence. And Georgia, Alabama, it's $1 million per occurrence. New York, it's $1.3 million per occurrence. There's all these little industry standards, but then we have clients that say, "Hey, I want more." I mean, we're cutting people open every day, and we're right in the heart. In Atlanta, it's become a very litigious place. Georgia is one of the worst states, and is emerging to be one of the worst states for claims in the country. Not so much in the rural areas, but right in the heart of Atlanta. So is $1 million enough? I'm not sure how to answer this question, honestly. It's a personal preference, but I can show you some data that backs up, the trends of how much people buy and limits and how much claims tend to be. How do you insure your corporate entity? You'll want to make sure they're on the policy, at least. If you have multiple providers, you may want to consider a separate limit. So if there's 3 in your group, and you may want to have a separate limit of insurance in case your corporation is named. It provides another level of protection. Insurance limits stack in this industry. So if you have $1.3 million, your partner has $1.3 million, and your corporate entity has $1.3 million, then you would potentially have $3 million for any claim that named all 3 of you. So that's another way to get more limit. What happens if I have a physician that departs? We talked about that a little bit. They can buy tail coverage. They can transition to a new policy. They can take their prior acts to a new place. Mid-levels are often covered automatically on a physician's coverage. So if you're a supervising physician and there's a claim that results from one of your mid-levels, that would go into your policy. It wouldn't go against you on your data bank, but it would definitely go against your claims history. Some carriers have loyalty programs. I don't know that we have the time to get into the nuances of that, but that's something to consider. How much limit should it purchase? The intent of this graph is to show you the statistics on, this is particularly in Florida where a lot of physicians buy 250, 750, and then they go up from there. This is typically the industry standard around the country. So we'll see 250, 750. And this means that for the 250, 750, means that for every one claim, an insurance company will pay $250,000. And in any given year, they'll pay up to $750,000. And then that refreshes on an annual basis. So it doesn't carry forward for your career. Every year, you would get a new set of limits. And so if you had this, in this case, to exhaust your insurance completely, you'd have to have 3 separate claims that all paid more than $250,000 or $250,000 or more. I mean, you could have 10 $7,000 claims and you still have coverage. But this graph shows that the average indemnity payment trends based on how much they buy. So as an insurance broker, we want to sell as much insurance as we possibly can. And people ask us, what should we buy? I mean, the data doesn't lie. The trends, if you have $2 million or $1 million, does it make you a bigger target? Well, perhaps, but you have the coverage. You can see the average payout is still significantly less than the coverage that you're purchasing. But there's a chance. There's always a chance that you could be sued and have a judgment that's more than your limits. Well, I mean, off the record, I could tell you what happens. I mean, traditionally, if you're defending the claim, and when you're with a carrier that's a medical professional specialist, they're going to defend it with you. They're right there with you all the way to the end. And you lose $1.5 million. Well, they're going to make a decision on whether they should appeal it. And if they appeal it, then they're continuing the process with you. And often we see those carriers end up, if it appeals and loses again, and there is a judgment that's more than a limit, we see them standing beside the doctor and making those payment claims. Not saying that contractually they're not obligated to it, right? But if you have a mutual company, that's going back to the mutual versus stock. A mutual company there's a board of directors that are physicians, right? Their profit goes back to the physicians that buy the coverage oftentimes, or they're reinvested to make the company better. So their intention is to make sure that if you're sued and you lose, that you're not out any money. They're not going to tell you. And in other cases where there's just gross negligence, there's no way they're going to chip in the more money. But sometimes, there's other nuances. So we don't often see a single person have to pay, more than what their limits are. It's rare. Might be a question for a NorCal representative that's here in the room. Ask him later what he's seen. How do I find coverage? Well, we get this. Obviously, I'm an independent broker, so full disclosure, I'm a little biased. And one second, how am I doing on time? 10 minutes, okay. I'm a little biased because I'm a broker, and when the hard market occurred, many of the providers all of them that popped up were direct. I mean, Medical Association of Georgia said, hey, let's find a solution for our members. They created a solution and sent it out to Marketplace, and then they've grown into a direct market in Georgia mostly, and in ProAssurance in Alabama and Macam. But with all those terms that we talked about, do you have written demand? Do you have incident-sensitive triggers? Where's my premium going? Those direct carriers, they work for the companies that you're buying your insurance for. So it is my suggestion that you work with an independent advisor. There's a whole lot of reasons for that. As an independent brokerage firm, they can provide you with advice. They have options. If your specialty is anesthesia, Mag Mutual may be the answer for that in your county with the best rates, best coverage. If it's Another county, it might be NorCal. Another county, it might be another carrier, right? So if you're looking truly for the best possible coverage and terms, you want to be able to quote the marketplace. And you can Google it and you can reach out to every single one and they'd probably be happy to give you a direct quote. But you may not get the advice that you're looking for. My recommendation for any independent physician in the room is to look at grouping up in some kind of a way through your local association, a group purchasing organization. If you're not looking at getting onto some sort of group platform, then if the market hardens, then your rate may just increase year over year just because you have no say so in the market forces, right? There's no buying power. So your $15,000 just went from 15 to next year it's 15.5, and the next year it's 16.5, then it's 18. Whatever it is, I mean, we're seeing a trend of going up, but if you get onto a group platform, which is in medical malpractice industry, there are no laws against it. So if you're an association, you can group up and say, hey, we're on a group platform. We're not legally on the same entity at all, but we're negotiating together. We want one carrier to come provide us with a great program. So I would suggest anyone who's not doing that in a group negotiation to do so. There's a lot of different ways you can buy medical malpractice insurance. But for a solo practitioner and the majority of the SMA members, first dollar, no deductible. I'm buying $1 million, I've got no deductible, and that's pretty standard. You get a little larger, there's a lot of creative options in the marketplace. Last thing, risk management. I'm not a clinical risk manager. I'm an insurance broker. And so our advice is a little more technical and sort of processes. I would encourage that whatever carrier you are working with, they all have access to CMEs and risk managers. And when you have a direct clinical question, you can call up their 800 number and say, hey, I had this happen. What do I do? But for me, I'd say, you want to create a culture of safety. Incident reporting. How do you do that? What's the process there? If you have people underneath you, do you have a process where they can approach you? If something were, an adverse occurrence, what's your follow-up process with the patient? How do you document? Have you reviewed your contracts? Because sometimes we'll see that people are contractually obligated to liabilities that they don't want to be. So whether it's with the hospital or some other third party. So review those contracts to make sure you're not doing that. So CMEs and education, risk management audits. A couple things as we close, I'd say to think about is additional coverages. Medical director, we get this question a lot right now is, hey, I'm a plastic surgeon. I want to be a medical director at the Medi-Spa, and they're going to set up appointments for me, and they're going to get some access to some creams or something. And that's fine, but as a medical director, that's not medical malpractice. You're coming in as essentially a management liability exposure, and your MedMal policies almost always don't provide that coverage for you. So if you're sued for lack of oversight as a medical director, it's not a medical malpractice coverage. It's an administrative type of risk. And so you want to make sure that you have that covered by whoever is asking you to be the medical director, whether it's the hospital. Hospitals have directors and officers policies. You would be on that coverage. And so that's something to consider. Employment practices liability. If you're sued for an allegation of wrongful termination, discrimination by a patient or an employee, you want to make sure you're covered there. And then you have the cyber and administrative and things that I mentioned before. And then finally, I'll run through the test questions real quickly and see if somebody can help me out here. But can anyone explain to me, within the context of settling a claim and the insurance contract, an idea of what the hammer clause